Recap. Last time, when we discussed the financial crisis of 2008, we decided to follow a particular path. Firstly, we constructed a definition fitting for the crisis, and from that definition, we explored its structure and its nature. Secondly, we decided specifically not to think about timelines of events. We didn't want to think about the financial crisis in a linear way, because linearity often misses the arc of the story. And though it tells a narrative, it often lacks the power to see a bigger picture. We then built some simple and then more complex pictures of how the economy passes on risks, and we labelled these financial ecosystems. Finally, we brought all of these thoughts together to discuss a systemic overview of the crisis, and we mapped this to the flow of time before, during, and after the financial crisis. Definitionally, we decided that the financial crisis was a globally connected episode where confidence in banks and between banks evaporated, leading to a sharp and prolonged impact on balance sheets in the public and private sectors. Now that's fine as a working definition, but let's try and break that into some statements that we can draw from. And then let's consider how those statements manifest themselves in our systemic analysis. The three key nodes. For today, I'd really like to focus in on the part of the definition which says confidence in banks and between banks evaporated. And in order to do that, we can examine the top right part of our systemic interpretation of the financial crisis. Here, we can pull out the following statements about relationships between three key nodes, namely investment banks, the repo market, and special purpose vehicles, or SPVs. These are, firstly, the repo market allowed investment banks to lessen their requirement for long-term funding and asset-to-term funding. Secondly, investment banks were able to package and partially take off-balance sheet assets which were placed into special purpose vehicles. Thirdly, the repo market allowed SPVs, or special purpose vehicles, to roll short-term the finance for long-term assets. For some listeners, these might seem pretty arcane, and for others, these are very vanilla statements. For the sake of everyone, I'm going to try to now rewrite these in much plainer English and using non-financial terms. So firstly, banks lent money for long-term projects, such as individuals buying homes, and they themselves borrowed some of this money from a market that only lent it short-term. Secondly, banks were able to take claims relating to the money they had lent for the long-term projects and put them into new pools, allowing the size of these loans to become slightly less visible. Thirdly, as banks used more and more of these new pools, they realised that they had to ask the pools to borrow short-term rather than asking the bank to lend for a longer-term period. So we can begin to see that there is an interplay here between what are assets, what are liabilities, what is borrowing, and who is charged with being the lender. And as well as this, we can see that there's something else happening. There's an interplay allowing for banks to grow their lending much more efficiently as the extent of that lending is partially obscured. And the borrowing to support that lending can easily be accessed in short-term loan format in the repo market. And this can be matched against long-dated loans that the banks themselves have made. This is credit creation, of course, but it's credit creation where the creation of credit is only one of the legs of a stool. The other two legs of that stool are matching short-term borrowing from money markets, which need to be revisited and re-agreed on a very regular basis, against long-term lending, and aligning this with allowing borrowing to grow larger than is initially obvious from a glance at the bank's balance sheets. The repo market. This leaves us with a big question. How is it possible that we can take this efficiency, this three-legged stool we described, which provides financing to grow lending in a profitable way, and connect one of the nodes, the repo market, directly into the seeds of doom? How can that be the case? Well, the link states between these two nodes, between the seeds of doom and the repo market, comes from this statement. There is a huge over-reliance on the repo market, causing a funding and asset liability management mismatch. Put simply, the credit creation process, which has to exist in order for the whole system to make sense, becomes so supercharged by short-term financing and the ability to lend more money than was primarily obvious, that it became a problem for the whole system. There is an aphorism I remember being told years ago: if you borrow £1,000 from a bank, it's your problem. But if you borrow £1 million, it's their problem. Now, quite probably, the number of zeros has changed a bit since I was first taught that. But what about this? How many zeros does it take from an individual problem to become an institution problem? And how many more zeros do we need in order to make an institution problem a systemic problem? Is this the same question we had above, in that how can an efficient financing system using the repo market be a partial cause of the seas of doom within the context of the financial crisis? The lesson. If we have a system in place which has integrated processes that themselves have fast-moving parts that require constant attention, then that system almost certainly requires some form of mechanism for control and balance. Now think about our systemic approach to the financial crisis, and think about the three nodes in the form of the investment banks, SPVs, and the repo market. The repo market was providing the balance, or if you liked, was performing a balancing act for the whole system. The repo market was the efficient control and the friend of the system, but at the very moment the system needed that control and balance, the repo market became the detonator. More pointedly, the repo market and its refusal to continue to finance assets, even for very short periods, which it considered potentially worthless, led to a catastrophic change in the system. In fact, it led to an evaporation of confidence in banks and between banks. And one final point I'd like to make before we move on is this: that we really should put a name to the fate of the repo market. I mean, what right did this market have to withdraw confidence and liquidity? Well, the problem was, and still is that the repo market is none other than the banks themselves. The evaporation of confidence in banks led to an evaporation of confidence between banks, which led to an evaporation of confidence in banks. The control mechanism became the detonator. Just looking back at our systemic diagram, one of the connections with investment banks reads that investment banks innovated credit product. One artifact of that innovation is this: that the speed with which sticky long-term lending, such as mortgages, could become shaped into a commodity that could very easily be purchased and passed on is the following. The ability to take loans and convert them into securities which could be sold facilitated much smoother and quicker transfer of risk. And in addition, the tailoring of that product through tranche technology allowed a new array of securities to be created which would suit a plethora of investor tastes, which of course further encouraged investor participation and created new waves of demand for credit product. In some senses, of course, we could conclude finding long-term investors to purchase long-term loans did what should have been done, matching long-term liabilities with long-term assets. This surely was better than relying on the short-term nature of the repo market. Now that would be fair as an observation. However, there was another frailty in the system here, almost certainly not perceived when these securities were being created in the mid-noughties. The frailty could be summed up as model risk. Now, during the creation of credit product, from very simple examples whose values depended only on a single variable, to much more complex structures which depended on financial calculus, models had been developed hand in glove with the product. And the purpose of these models was foremost to take observable market variables in order to calculate consistent valuations for products which could not otherwise be observed in the marketplace. In other words, the legal and structural process of converting sticky, long-term loans into securities, which could then be bought and sold, needed to have a framework which gave confidence that the valuation and therefore the liquidity of these products could be upheld during different market conditions. In turn, that supported the ability and the willingness of the repo market to finance those securities. The valuation technique and the values themselves were clear, they were manifest. Furthermore, given that this modelling could be carried out by credit rating agencies, these agents themselves could then ascribe credit rating and default probabilities to these securities, using the same or similar models. Now, on top of this, credit insurance companies themselves, rated by credit rating agencies, could enhance the products by promising to stand behind them in different market conditions. The innovation, design, modelling, rating, wrapping, distribution and financing process was now complete. Clearly, the underlying loan, the bank, the rating agency, the credit insurer, the finished product, the investor could be anywhere on the globe. And the interdependency and the speed with which more interdependency could be created was pushing ahead at pace. From this point, there is no doubt that globalization had made the banking system more connected and more interdependent. However, a scientific analysis of how much more connected it was in 2008 versus, say, 10 years earlier is not something we're going to focus on today. Instead, what we've chosen to do is to simply accept this interconnectedness, the blossoming and innovation of credit products, and the reliance on repo markets. Interconnectedness, innovation, and reliance on the belief in interconnectedness and innovation was the story of the run-up to the crisis. A closer analysis of the systemic nature of the institutions and their interconnectedness, particularly around the willingness and the ability to finance each other, proved to be the trigger to the evaporation of confidence in banks and between banks during the crisis. The balancing act around stability and equilibrium could only last as long as the whole believed in the parts.